For more analysis of that Fed decision, Diane Swonk joins us. She's chief economist at Mesirow Financial. Hi, Diane. So the Fed is sticking to its plan. No real surprises today. Did anything stand out for you?
You know, there really wasn't much that stood out, and I think that was important. The real issue here is that the Fed is still continuing to be the sort of lifeboat of certainty in this ocean of uncertainty for both consumers and investors alike, saying we're willing to leave that punch bowl out there for a little longer than anybody thought and maybe get a few people tipsy, as I think some people behind me are doing right now.
Yeah. Well, you know, there wasn't much market reaction to the Fed decision. Do you think that the message of the markets is that there's really not much more that the Fed can do to fix the economy?
I don't think the Fed is out of bullets at all, nor do they. They do think that every time they do something, they need to do more, that it does wear off over time. And the Federal Reserve is certainly going to make another announcement in December to compensate for the end of what they call the twist, after Chubby Checker's song, The Twist. They're going to continue to buy more Treasury bonds, as we heard earlier in the program, and expand their balance sheet further. I think we'll see over $1 trillion spent. The problem for the Fed is that it's almost as if Ben Bernanke has dropped the money from his proverbial helicopters and it's gotten caught out of our reach in the trees, and they're trying to shake it out of the trees and have it fall to the ground so we can pick it up and spend it a little more.
You know, a lot of people at home listening to this, a lot of them, you know, going to be voting in the election. They're trying to figure out what's going on in this economy. And we seem to be getting two different pictures. We have companies saying that the outlook is bad. We're hearing that they're beginning to lay off workers. They're closing plants. They're cutting costs. And yet the message from the report card from the Fed today sounded a little bit more encouraging about the recovery. So which is it? Clear it up for us.
Well, what we're seeing is the manufacturing sector, which had been the shining star, has handed off the baton to the housing sector, which has been absent during much of this recovery because, of course, it helped to cause the recession. The fact that the housing sector is coming back is a really powerful message out there. I think very important that housing prices have bottomed. That's the largest wealth effect, the largest equity holding for most consumers. And that, along with the fact that we're building homes again, particularly single-family homes, biggest bang for our dollar in terms of employment, single-family home construction per square foot, bigger than apartments, and that's now happening again. That's an important start in the right direction.
You know, Warren Buffett said today that it, you know, really doesn't make a difference which candidate ends up in the White House. American businesses and the economy will improve under either one. So does it really matter who wins the presidential race?
You know, I spend more time understanding politics to handicap what's going to happen with fiscal policy, tax policy, spending policy, because that matters at this stage of the game. But really, it's the game changer here is not necessarily the presidency, but who wins the Senate and whether or not they can work with the next president to come up with something feasible for deficit reduction in the longer haul, so we all have a roadmap going forward, getting rid of some of that uncertainty we've all been having to deal with on taxes, spending, and everything else out there.
All right, so we have one more meeting of the Federal Reserve before the end of the year. Anything that we should be expecting, or what are you monitoring over the next couple of weeks and months?
What we will see is I think the Fed will expand their balance sheet further in December, and as we get into next year, I do think we will see that shift where the Fed stops talking about calendar dates in terms of keeping monetary policy easy and actually starts explicitly targeting the unemployment rate over a period of time. We'll see something like we'll keep monetary policy easy and continuing to expand our balance sheet until unemployment rate falls below 7% for a extended period of time, or 7 to 7.25. They haven't decided on the actual rate yet. That I would have loved to have been a fly in the wall of the room today, because my bet is there was a lot of debate over that. But that is where they're moving to try to get more explicit targets out there so people really know what the Fed's trying to do.
All right, we're going to have to leave it there. Always great talking with you, Diane. Thanks so much. Diane Swonk, chief economist at Mesirow Financial.